A bear market is a period when the prices of assets go down. This is often followed by widely pessimism and negative investor sentiment. When it comes to cryptocurrencies, bear markets can be very volatile because the value of digital assets can change a lot in a short amount of time. It's important to have a plan for how to handle a bear market, because it's easy to get scared and make bad choices about your investments when the market is down. By making a plan and sticking to it, you can make smart decisions and might even come out ahead during a bear market. Let's see a few ways to make money in a bear market for cryptocurrencies. HODL strategy. The hold on for dear life strategy is to keep your cryptocurrency investments for a long time, even when the market is down. This strategy is based on the idea that in the long run, the value of the cryptocurrency will recover and go up. One benefit of the HODL strategy is that you may find it less stressful because you don't have to trade actively or try to time the market. It can also be a good choice for you if you think the cryptocurrency you have invested in will do well in the long run. But there are also some things that could go wrong with the HODL strategy. If the cryptocurrency's price doesn't go back up as expected, you may miss out on chances to sell at a higher price. This strategy also requires a lot of patience and self-control, since it can be tempting to sell during a long bear market. Dollar cost averaging. Dollar cost averaging is a strategy that involves investing a specific amount of money at regular intervals instead of a lump sum all at once. This can be a good option for people who are worried about investing a lot of money in a volatile market, like a bear market for cryptocurrency. To use dollar cost averaging in a cryptocurrency portfolio, you can set a certain amount of money that will be invested at periodic intervals, such as monthly or quarterly. This can be done by using a cryptocurrency exchange's dollar cost averaging plan or by buying the intended amount of cryptocurrency at regular intervals. One good thing about dollar cost averaging is that it can help make your investments less sensitive to changes in the market. By putting in a set amount of money at regular intervals, you average out the price per unit of cryptocurrency over time. This can help minimize the chance of buying something at a high price and then selling it for less. But there are also some things that could go wrong with dollar cost averaging. For example, if the market keeps going up, if you use dollar cost averaging, you may ultimately pay a higher average price for your cryptocurrency than someone who invested a lump sum all at once. Also, dollar cost averaging needs a longer time frame and a lot of self-control to stick to the plan, since it can be tempting to change the schedule based on how the market is doing. Trading in a bear market. Trading can be a good choice for you if you are comfortable with the risks and have the knowledge and skills to make it through a bear market. But it's important to know that trading in a declining economy comes with its own challenges and risks. Here are some ways to trade well in a bear market. It's important to know what's going on in the market and with the cryptocurrencies you're interested in trading. This will help you make better decisions and maybe even spot good buying and selling chances. Before you start trading, you should know what you want to achieve with your investments and how much risk you are willing to take. This will help you trade with more thought and strategy instead of just reacting emotionally to changes in the market. A stop-loss order is a type of order that sells your cryptocurrency automatically if its price gets to a certain level. In a bear market, this can help you lose less money. Diversifying your portfolio is usually a good idea, even in a bear market. This can help spread risk and may lessen the effect of the performance of any one cryptocurrency on your portfolio as a whole. When trading in a bear market, here are some common mistakes to avoid. Trying to follow market trends. It can be tempting to try to follow market trends and buy the latest, hot crypto. But this can be risky and lead to bad choices about where to invest. Failure to cut losses. It's important to be willing to cut your losses and sell off cryptocurrencies that aren't doing well, instead of holding on to them in the hopes that they'll get better. Getting caught in the FOMO trap. FOMO, or fear of missing out, can be a strong force in a bearish trend, as you may feel pressure to buy in to avoid missing out on potential gains. But it's important not to trade on the spot because you're afraid of missing out. Alternative investment options. During a bear market, you might want to think about other ways to invest besides traditional cryptocurrencies. Stablecoins and non-crypto investments are two options to think about. Stablecoins are a type of cryptocurrency whose value is tied to an outside asset, like the US dollar. Stablecoins tend to be less volatile than other cryptocurrencies because they are tied to a stable asset. They can be a good choice for people who want a more stable investment in a bear market. But still, be careful, we all know what happened to Terra USD. During a bear market, you might also want to think about investing in things that aren't cryptocurrency. These could be things like stocks, bonds, or real estate, but they could also be things like precious metals or art. Before making a decision about a non-crypto investment, it's important to do a lot of research and think carefully about the possible risks and returns. Overall, it's important to think about a variety of investment opportunities, both inside and outside of the cryptocurrency market, so that you can diversify your portfolio and maybe make a bear market less bad.